The year is 1960. You were living in a modest, single-family home with a backyard in the suburbs outside of sunny Los Angeles with your wife, 2 kids, and your dog named Lucky. The American economy is booming. Your yearly income is a whopping $5,600, and you just bought a house for $11,900. A bit more than twice your salary, and you know you could have gotten a better deal. Anyways, your wife is happy with her dream house, so happy wife, happy life. Fast forward 60 years. It's now the year 2022. You've just lived through a global pandemic and been living with your girlfriend for the past 2 years in a small studio apartment in North Hollywood, paying $2,000 per month.
COVID restrictions,
COVID-19,
coronavirus pandemic.
The COVID cases once again topping 100,000 each.
Things are going well and you're thinking of buying a house because you have a baby on the way. So you start searching. Your combined income is $80,000. But you quickly find out that you can't even qualify for a mortgage to buy a house because the median list price for a house in Los Angeles is $985,000, more than 10 times what you and your partner make combined. So what changed over the past 60 years? And why has housing become so unaffordable? In this video, we'll address those questions and cover why prices should continue to climb. More importantly, we will cover the 4 core drivers of real estate prices, including inflation, interest rates, supply and demand, and the financialization of the economy. So stay tuned until the end of the video to be better equipped for your next move in the real estate market. All right, Wolfpack, let's get started. Have you ever heard the saying, housing prices always go up? People say this because it's historically been true, with occasional dips in the housing market, of course. But what they should actually be saying is housing prices always go up because the cost of goods and services always go up with inflation, including housing. And you can depend on the Fed to print money to drive asset prices up. In fact, part of the Federal Reserve's mandate is to maintain positive inflation at around 2% per year. But home price increases have outpaced inflation by more than 300% over the past 60 years. So inflation must not be the only driver of home prices. There must be something else driving higher home prices. Have you ever been approached by a real estate agent telling you that the time to buy is now, that you won't want to miss out on all-time low interest rates, that people have made millions in real estate and you can too? Well, it is true that some people have made a lot of money in the real estate market over the past decade, but have we ever really stopped to think why that's the case and whether we could expect the same in the future? A key detail real estate agents won't tell you is that a meaningful portion of the outsized large price gains in the real estate market since the 1980s is attributed to declining interest rates. In the chart, you can clearly see an inflection of higher house prices as interest rates fall from 17% in the 1980s to 3% in 2021. And real estate agents also probably won't tell you that with interest rates near all-time lows, that there is limited room for interest rates to fall even lower. In other words, the same large price gains that we have seen over the past 40 years are less likely in the future. Before we continue with our story, you might be saying, hey Wolf, why do interest rates even matter for real estate prices? The simple answer is that lower interest rates make it cheaper to buy a house, and it increases a buyer's ability to pay, increasing demand and driving home prices higher. However, interest rates alone still don't fully explain higher housing prices. Florida is home to the least affordable places to live. But did you also know that these places became the least affordable in the span of only 1 year? The reason why comes down to supply and demand, and no other place has been affected more than Miami, Florida, which saw a 50% spike in its rental prices from 2020 to 2021. So what happened? Well, as you can imagine, a lot of people moved to Florida during the pandemic as they could now work remotely while enjoying beautiful weather, lower personal restrictions from COVID, and no state income taxes. In simple economic terms, high demand and low supply drove higher prices. But Miami is a microcosm of broader issues of supply and demand in the real estate market. And the larger issue across America is that a decade of inadequate building of new housing following the great financial crisis has caused higher home prices. The good news is that the home building industry has bounced back steadily since the great financial crisis. Although the construction of new buildings has largely recovered, more housing still needs to be built to cover the housing units that were underbuilt over the last decade. But the home building industry alone doesn't fully explain why we have a housing shortage. Overly restrictive zoning and other regulatory issues are also a big problem. Los Angeles has one of the highest housing prices in the country. Although it is a beautiful place to live with sunny weather and scenic beaches, zoning decisions have caused the median house price in Los Angeles to be just under $1 million, while the average household income is just under $110,000. In other words, you'll have to spend 9 times your salary to buy a house. That's a lot of money. But these prices are actually not that crazy high when you consider the context. The Los Angeles landscape is like no other place in the world, with nearly 2 million single-family homes over 4,000 square miles. Los Angeles should have probably built more multifamily units like most major cities to address housing affordability, homelessness, and traffic. Must have been poor planning, right? Well, have you ever thought that it might be by design? Think about it from a homeowner's perspective.
If you look at the 13 units that will be added here, it's a 33% increase on this block, this area, with no accommodation for sewer, water, trash.
Rosenzweig and his neighbors put up signs that say no to backyard apartment buildings.
Wouldn't you want to keep supply down to help drive a higher price in your home? It's no surprise that supply and demand dynamics across different regions have been key drivers for housing prices since the beginning of humanity. But there is a new development in the real estate market that has been slowly building over the past several decades that could continue to push prices even higher. Have you ever heard the term financialization?
$350 switch. Wird dir wahrscheinlich nicht so toll werden hier.
Ich glaube, im Moment kommt nichts Neues raus.
Zurich, 23, Citibank.
This is just one of Citicorp's nerve centers.
If you have, you're probably a finance nerd like me, but if you haven't, I'm sure you've heard the term mortgage-backed security, or MBS. The mortgage-backed security essentially financialized the debt side of the housing market in the United States by allowing bankers to sell mortgages to pension funds, sovereign wealth funds, and other institutions. And what I mean by financialization is that the mortgage became a commodity that started to become treated as a vehicle for wealth and investment. The creation of the mortgage-backed security marked a shift in the way that the financial world and many homeowners viewed their homes. It was no longer just a home that signified the achievement of the American dream for families and their future generations. but it became a financial asset. This trend has continued, and we are now seeing the financialization of the equity in housing. We are seeing the total commodification of homeownership. You've probably heard of real estate crowdfunding sites like Fundrise, CrowdStreet, and Realty Mogul that allow you to invest in real estate projects for as little as $10. This exemplifies the commodification of housing, but the big, smart money that has been slowly buying tens of thousands of houses in the United States are large institutions like private equity companies. And I would argue that commodification of housing in the United States is just getting started, setting the stage for a multi-decade trend of higher housing prices. Only 2% of single-family rental units in the United States are owned by institutions. That is a minuscule percentage. So corporate buyers must not be behind the rising housing prices. Well, not so fast. Remember how I said we are in the beginning stages of the commodification of housing? The metric we should actually be looking at is the percent of homes that have been bought by investors over the past several years. Although corporate ownership is 2% today, currently more than 18% of all homes are bought by investors, and that number has steadily been increasing since the great financial crisis. And growth trends at large publicly traded corporate buyers like Tricon Residential, ticker TCN, suggest that this trend can continue. Tricon currently owns 30,000 single-family rental homes in the United States and has plans to double its portfolio over the next few years. And if things go according to plan, the CEO expects that in the future,
rent your American dream.
If you made it this far in the video, congratulations. You now understand the fundamental drivers of housing prices, but we still haven't fully answered where housing prices go from here. Real estate prices will vary depending on location, but which locations will benefit the most? Well, why don't we check where the smart money is investing? Tricon is primarily targeting the Sun Belt, which makes a lot of sense. In the post-pandemic remote work world, people are able to move to places like California, Texas, or Florida, where you have better weather and amenities than places like the Northeast or Midwest. An offsetting factor will be a stronger housing construction industry that will alleviate housing price pressures in the future. However, tailwinds in the home building industry won't benefit places like Los Angeles, where zoning and regulatory issues limit the build-out of new housing units. Interest rates are also a wild card, but with the Fed hiking interest rates, this could also limit how much housing prices can climb in the near future. And since the beginning of this year, interest rates on a 30-year fixed rate mortgage have already climbed from 3% to over 5%, getting to the highest level since 2009. In the short term, we could expect asking prices for homes to continue falling due to high interest rates. But longer term, housing should benefit from inflation. Also, the entrance of private equity into the housing industry over the past decade indicates that housing prices can continue to climb. We would likely see a dip in prices during a recession, but the downside in housing prices won't be at the same magnitude that we saw during the Great Financial Crisis. The difference now is that institutional private equity investors and other investors would be the incremental buyers in a recession and would swoop up any housing stock supporting housing prices. And they already have a war chest to benefit from a buyer's market. Global private equity has more than $3 trillion ready to be deployed on investments at any given time, with $300 to $400 billion dedicated specifically to real estate. And each year that passes, global private equity raises an additional $1 trillion. So if you're waiting for the next real estate market crash, good luck waiting for good deals. You'll also be waiting with private equity giants with much bigger pockets than you. So what does this all mean for you? Well, if you're interested and capable of buying a house but are waiting for a lower price, I would reconsider, especially if you plan to live in that house for the next 20 to 30 years, because in the long term, inflation and new buyer demand from institutional investors will continue to push housing prices higher. By investing in a house, you'll be benefiting from a mega trend in the financialization of the housing market. Also, the economics of buying over renting a home is beneficial over a long period of time. But let me know what you think in the comments below. Did I cover the key drivers of housing prices, or was my analysis completely wrong? Let me know what other factors you would consider as key housing price drivers, and your view on where housing prices go from here. And let me know if you would like me to create a follow-up video to help you with deciding on whether you should buy a house by using financial modeling. And if you're watching this video right now, thank you for watching until the end. You are now one step closer to becoming a real estate pro. Subscribe now and hit the notification bell to enjoy more of these videos on all things business, investing, and entrepreneurship. Also, leave a thumbs up if you learned something new throughout this video. It really helps with the YouTube algorithm and helps me to continue making new high quality videos for you. Thank you for listening, and I'll see you at the next one, Wolfpack.